This presentation will give you a quick overview of the foreign exchange markets. I'm Pat Obi, Professor of Finance at Purdue University, Northwest. I begin with a quick definition of what exchange rate refers to. Now, as you know, in the foreign exchange market, currencies sell as financial assets, and the price of a currency is what we refer to as the exchange rate. Exchange rate can be expressed in direct quotes or indirect quotes. If it is in direct quote, then you're talking about the price of a foreign currency in units of the domestic currency, in that all goods and services in the domestic country are expressed in your own currency. So here, from the standpoint of an American, when we say, for example, $1.25 per euro, this is a direct quote. Indirect, on the other hand, would be when the price of a currency is when exchange rate is expressed in units of a foreign currency, in this case 80 euro cents per dollar. And so with your financial calculator like this, if you can move back and forth from a direct quote to an indirect quote by using the 1/x key, 1.25 $1.25 per euro can be where you can find what it would be in terms of euros per dollar by clicking this key. So this is the price of the US currency expressed in units of the European euro. And you can click it again to go back and forth and play with it. Right? So it's a very valuable key in the pricing of currencies. Now, another description is in the sense as to whether the exchange rate is a spot exchange rate or a forward exchange rate. A spot exchange rate, as I note here, is going to be the exchange rate for current delivery. So when you travel overseas and you see the exchange rate board, that is the rate of exchange at that point in time. That's a spot exchange rate. Now though, but when you agree to an exchange rate for delivery that will be made some point at a defined point in the future, that's a forward exchange rate, or if you like, a futures exchange rate. The foreign exchange market is also referred to as a Forex market, and exchange rates can be represented by the notation FX, F as in Frank, X as in Xerox. Now though, cross exchange rate is a case where you infer on the exchange rate between two foreign currencies, as in, say, for example, euro and pound sterling, with respect to their individual exchange rates with respect to the US currency or some underlying currency. So here, for example, if the dollar euro exchange rate is $1.10 per euro and the dollar pound exchange rate is $1.25 per pound sterling, by dividing the dollar pound exchange rate of $1.25, $1.25 per pound, by the dollar euro exchange rate of $1.10 per euro, you find the euro pound exchange rates. So as a reminder right here, when you divide two fractions, the result is going to be the product of the two fractions with the denominator fraction inverted, as I show here. So that's going to come out giving you E over pound sterling, which is what you see right here. And with your flip over button, which is your 1/x button, I call it flip over button. So you can flip it over and find what it would be in terms of pounds per euro. So I show you here what the exchange rate situation was among the major currencies back in 2011. At the time of this recording, it's February 2017. So here you can see what the exchange rates are for these various currencies. I guess first of all, currencies go by three-letter symbols. So this is euro here, and this USD is US dollar. JPY is Japanese yen, GBP is Great British Pound Sterling, AUD is Australian dollar, CAD is Canadian dollar, and CHF is Swiss franc actually. And so here at the other is this forward slash that you see here is actually not a division sign in this case. It's an argument that separates these two currencies, telling you that the currency on the right side is the currency whose quotation unit is whose notation is used for this quotation unit. So this here is going to be US dollars per euro. So this is going to be $1.4179 per euro. Now the other is this forward slash that you see here, in some of the cases, in some financial press, you may actually see it shown as a dash or as a colon. So it goes by any of those three arguments: forward slash, colon, and dash. So now the other thing that you need to know is as you go through this table right here, again, the currency on the right side is what determines the quotation unit here. So again, this is in US dollars, and therefore it's a direct quote. JPY though is on the right side, so this tells you is Japanese yen per dollar. So you can see that back in 2011, this is how much Japanese yen that you're going to need per US dollars. Now in 2017, as of the time of this recording in February 2nd, 2017, it's going to be about 113 thereabouts Japanese yen per dollar. So you can see that the dollar has strengthened as well. It's strengthened against the euro because as of now, it's going to be around $1.07 per euro. Now this is going to be direct quotes. US dollars per British pound sterling. Currently it's going to be around $1.25 per pound. And this is US dollars per Australian dollar. Now the table has turned, so you're going to have to be needing much less than this amount per Australian dollar. And Canadian dollars is also flipped. Here you only needed about a little over 98 Canadian cents to buy one US dollar, but now it's going to be about $1.32, 1 Canadian dollar 32 cents to buy one US dollar. And finally, right about now, it's going to be the US dollar and Swiss franc are going to be about going to be at parity. So let's go and see what's going on in the foreign exchange market currently. And this is February 2nd, 2017, and you can see right here, euro dollar exchange rate 1.07 and change, euro US dollar Japanese yen, that's it, about 113. And for British pound sterling in direct quotes is 1.2481, as you can see. And then you can go back down. This is New Zealand dollar, as you see there. And then you'll also see a few cross exchange rates. All right, Hong Kong dollar is HKD, CNY is Chinese yuan, as you see there, 6.8649 Chinese yuan per dollar. As you can see, CNY is on the right side. SGD is Singapore dollar. INR right here is Indian rupee. MXN is Mexican peso, which has depreciated quite a bit. Prior to the election that brought Donald Trump into office, it was about 18 Mexican pesos, perhaps a little less than that. Now it's over 20 Mexican pesos per dollar. PHP is Philippine peso, and so on and so forth. All right. Going back to the presentation, a couple of transactions, examples of international transactions here. It says suppose the exchange rate between the euro and the dollar is $1.40 per euro. Later it says the dollar appreciates in value by 5%. What then is the new exchange rate? So, well, keep in mind, if you need to find if an asset has gone up in value, the first thing you want to know is what's the original price. Well, here the original price is not going to be $1.40. You can't price a currency in itself. You got to find what people are paying to buy one US dollar. In euros, it comes out to 0.7143. So basically, take this direct quote, flip it over to find the indirect quotes, because the indirect quote represents the price that people in Europe and foreigners are paying in euros to purchase a dollar. So now kick it up by 5%, and this is what the current value of the dollar is, 75 euro cents. But it says now show this result in direct quotes. So then use the 1/x key and flip it over to find what it is, what the exchange rate is, dollars per euro. Here it says a firm can produce a liter of oranges in the US, ship it to Spain for $1.75. If the firm wants a 50% markup on the product, what should the juice sell for in Spain, where the euro is the currency in use? So now, if you produce it and ship it to Spain for $1.75, and you want a 50% markup, then kick it up by 50%, and that's what it would be, 2.625 US dollars. However, they use euros in Europe, and so we're going to have to convert this amount to euros to know how much we would need to sell it in Europe so as to realize the 50% markup, and that's 1.875 euros per liter. But it says here, though, if the firm chooses to produce to produce a product in Spain where it'll cost 2 euros, and then it's going to sell it in the UK for £1 50 pence. Question is, what's going to be your profit in US dollars? So obviously the owner of this business is an American company. All right. So now we have to make a choice. We can either express everything in euros, which is the producing country, or in pound sterling, which is the selling country. I say let's do it in the selling country because that's where our bread is buttered, so to speak. So if we produce it for 2 euros, convert it to pound sterling right here at the given exchange rate, it comes out to 1.3659 pounds sterling to produce. And that means by selling it for $1.50 in British pound sterling, the difference between those two numbers is going to be our profit. Now take this profit based on the given exchange rate between the dollar and the pound sterling. I know this is unrealistic at this point in time. Nevertheless, using this exchange rate, we find that the dollar profit comes out to 0.275